Long before banks or modern finance, Caribbean pirates turned daring raids into structured investment opportunities. Investors funded ships and crews, turning chaos into potential profits across the seas. Contracts, letters, and ledgers documented who invested what and who would claim the loot. Even the smallest raid could yield fortunes when organized and backed by the right investors. Maps were priceless. Investors needed accurate charts to anticipate treasure and risk coins. Gold bars and treasure chests became instruments of investment themselves. Investors often waited months for a single ship to return. Patience was key. Profit sharing meant every crew member and investor had a stake in success. Letters of credit were exchanged between ports, allowing distant investors to track their stakes. Some investors never set foot on a ship, yet their fortunes rose and fell with each raid. Pirates became more than thieves. They became financiers in their own right. Treasure islands, hidden coves, and secret harbors were the backbone of investment security. Contracts ensured investors got their fair share, or the consequences could be deadly. Pirates diversified. Some raided ships, others ran trading posts, spreading risk. Exotic goods like spices and rum were often more valuable than gold on long voyages. Investors were meticulous, tracking every raid, every coin, every ship lost or gained. The Caribbean became a floating economy where trade and piracy intersected. Naval blockades and storms threatened investments, making every voyage risky. Investors pooled resources for larger raids, sometimes capturing entire merchant fleets. Dividing the loot required trust, contracts, and sometimes brutal enforcement. Some islands were effectively pirate banks, holding treasure for multiple investors. Even the act of burying treasure was an investment in security and secrecy. Over time, pirates became powerful enough to influence entire trade networks. Strategic alliances meant some raids were planned years in advance for maximum profit. By turning plunder into profit, pirates transformed the Caribbean into a high-stakes investment arena. Ships were often funded by dozens of investors, each with a share of the potential treasure. Privateering licenses blurred the line between piracy and legal investment. Letters detailing profits and losses were sent across the Atlantic, connecting distant investors. Maps were carefully drawn and updated, becoming valuable assets themselves. Pirate crews were motivated by more than greed. They understood the language of investment. Investors used spies and informants to reduce risk and maximize returns. Every captured ship had a ledger attached to it, noting owners, cargo, and investors. Unexpected storms could wipe out months of investment in a single day. High seas insurance emerged informally, protecting investors against total loss. Fortunes were hidden in treasure islands, creating early forms of offshore banking. Some investors never sailed but influenced entire campaigns from the comfort of their offices. Risk was calculated. No raid was random, every venture carefully analyzed. Exotic goods captured were often sold in distant markets for incredible profits. Strategic bribery ensured port officials allowed pirate ships to dock safely. Accounting for plunder required meticulous ledgers, often written in code. Pirates developed complex networks to launder treasure through legitimate trade. Crew members had contracts specifying shares of profits and penalties for desertion guns. And cannons were investments too. They protected the ships, and cargo pirates learned to negotiate, forming partnerships with merchants and other crews. Gold coins, silver, spices, and sugar became tradable commodities like modern stocks. Every raid had a projected ROI. Some were calculated down to the smallest detail. Port towns adapted, creating markets specifically for pirate investors. Pirates used intermediaries to sell treasure, keeping investors' identities safe. Letters and contracts formed the backbone of a Caribbean investment culture. Even small islands could be strategic hubs for treasure storage and trade. Some pirates became early venture capitalists, funding other captains' raids. Rum, sugar, and tobacco were as much investments as gold and silver. Maps and charts were prized possessions, worth more than some cargoes. Investors calculated risk using weather patterns. Naval patrol schedules and rival activity treasure hunts were planned like corporate expansions, with budgets and forecasts. The Caribbean was a high-risk, high-reward environment for both pirates and financiers. Every successful raid increased investor confidence and attracted more capital. Some investors diversified into legal trade to offset losses from piracy. Even infamous pirates maintained meticulous records for their backers. The concept of shares and joint ventures emerged naturally from pirate practices. Pirates built fortified coves to protect treasure, acting like early banks. Loot was inventoried, appraised, and divided in structured ceremonies. Pirate codes were written agreements ensuring fairness and enforcing contracts. Some raids were multi-year projects requiring constant investor updates. Investors demanded transparency, forcing pirates to innovate in bookkeeping. Merchant fleets became a mix of privateers, investors, and military oversight. Letters of credit allowed profit to flow across the Caribbean without moving physical treasure. Pirates and investors developed sophisticated communication networks across islands. Each raid was analyzed afterward to improve future strategies. Pirates became experts in logistics, supply chains, and asset management. Investors sometimes financed entire fleets, sharing profits and losses proportionally. The most successful pirates operated like CEOs, overseeing complex enterprises. Hidden coves, secret maps, and encrypted ledgers were essential to investment security. Trade wars and blockades could double or halve an investment overnight. Pirates understood risk, timing, and diversification. Centuries before modern finance islands became both markets and storage centers for investor capital. Investors learned to hedge. Some invested in multiple ships to mitigate risk. Pirates were early pioneers of private equity, pooling resources for large ventures. Insurance-like agreements protected investors if crews failed or ships sank. Pirate networks expanded to include smuggling, legal trade, and offshore storage. Some investors became legendary for their shrewd choices and profitable backing. Even celebrated pirate captains relied heavily on investor funding. Letters, maps, and ledgers ensured accountability and investor trust. The combination of daring raids and structured investment reshaped Caribbean economics. Pirates transformed the perception of risk, turning lawlessness into opportunity. Investors funded exploration, expansion, and even early banking infrastructure. Shared risk and profit-sharing agreements became the foundation of pirate-financed ventures. Pirate enterprises often operated across dozens of islands simultaneously. The most successful pirates were also master strategists and financial planners. By understanding the flow of treasure, pirates and investors created a new financial model. From hidden coves to bustling ports, investment networks spanned the entire Caribbean. Even after retirement, pirates continued to manage investments and mentor new captains. The era of pirate-financed ventures laid the groundwork for modern investment principles. Thank you so much for watching. If you enjoyed this, be sure to like, subscribe, and stay tuned for more amazing content.